My name is John Olson. I'm the CRA officer for Goldman Sachs Bank. And Goldman Sachs is a sustaining member of NAAHL, and I serve on NAAHL's board of directors. So we're excited to have this great panel of CRA practitioners for our CRA Practitioner Roundtable. I think it'll be a great follow to Mr. Phillips' comments. We have a chance to talk today about what's working with CRA, what's not working, and it's a fascinating moment to be having this conversation. I'm struck by the fact that one of the most senior-most officials at the Treasury Department has very substantive and thoughtful and detailed ideas about what needs to happen with the CRA. I think it's we're at a unique moment to be participating in this conversation. It'll surely continue, but we're delighted to have this panel today as we think about the CRA 40 years on. So maybe what we'll do is we'll start with some quick introductions, and I'll give an overview of how the panel will be structured. So Josh, if you don't mind just introducing yourself, we'll go down the line.
Josh Silver, Senior Advisor, National Community Reinvestment Coalition. Pleasure to be here.
I'm Gwen Robinson. I'm the head of corporate social responsibility for Santander in the U.S.
Good morning, everyone. I'm Robert Manuel, CRA Director for Wells Fargo Bank.
Good morning. Rafael Cestero. I'm the President and CEO of the Community Preservation Corporation.
And I'm Jim Capraro from Chicago. I was a CDC director for 35 years and a community organizer before that, although you never stopped being a community organizer.
Yes. Good, thank you. So a quick word about just how we'll structure our roundtable discussion. So we'll start with Jim. Jim, as he mentioned, has been in the business for a number of years. And he has a great kind of there at the birth story about CRA. So we'll ask Jim to start us off with a little bit of history about the CRA to start our conversation off. And then our discussion will be around two big questions or two big themes. One is, the first question will be, what is working about the CRA? How has it been important? What has its impact been? Another way of framing that same question is, as we talk about all these changes and reform and modernization, what do we want to preserve or keep about the CRA that has worked? So that'll be our first question. Our second big question is, what does need to change? What needs to be modernized, fixed, made more efficient? So that'll be our two guiding questions for our roundtable discussion. And then we do, obviously, I'm sure everyone in the room has their own thoughts about those two questions, so we'll do our level best to be concise as the discussion proceeds, and we'll try to leave a nice amount of time at the end for audience participation and questions. So Jim, if we could start with you, if you want to tell a little bit of your story.
Thank you. I'm going to stand. I, too, am older than CRA. Hard to believe. I want to take you back to 1971 in Chicago, in the neighborhood that I grew up in Chicago. So I want you to imagine 30 pounds less. I wish it were that easy. And denim with bell bottoms, flannel plaid shirt, hair down to here. That was me. Back in Chicago in 1971, I was 21 years old. And I won't tell you how I got there, but I was the executive director of the Southwest Community Congress at 21. The blind leading the blind at that point. A community organization on the southwest side of the city, blue-collar working class neighborhood. We called it St. Rita Parish because there were lots of Catholics, and it was very white and very middle class. Both my parents were factory workers. They met on a production line at Motorola in Chicago. We were having, on a Thursday night, we were having a board meeting in early 1971, and we didn't have Xerox machines. We had a Gestetner, and I'm running the agendas off because I had typed out a stencil to put on. And it's like 6:30 in the evening, and I'm getting ready for the meeting. There's a staff of one, who is me, and the board starts to come in. And a woman named Emily Thomas comes in, and Emily was in maybe her late 50s. And she lived just east of Western Avenue. If you're familiar with Chicago, Western is it is the longest arterial street, north-south street in Chicago. She lived 2 blocks east of Western on Oakley Avenue. Oakley Avenue. And as people were gathering, she started telling the story, and the story was so compelling that we tubed the agenda. I stopped running the Gestetner, and we spent the rest of the meeting talking about what had happened to Emily and her husband that day. Her daughter, this was maybe January or February, her daughter was getting married in June. They lived in a bungalow. Bungalows are brick buildings, 1,200 square feet, right? And on their block, a block full of bungalows, there were some what we in Chicago call hex front bungalows that don't have a straight front with 4 windows. They have a straight front, then 2 diagonal fronts, and there's 4 windows in each of those sides, and they're deluxe. They have prairie-style leaded glass windows in those. Well, there was a hex front bungalow in the middle of the block that her daughter always loved. She just loved this house. And it happened to be for sale. It happened to come on the market. So Emily Thomas and her husband went to Chicago Savings and Loan at 60th and Western, where they had a mortgage for, I think at the time it was 26 years on a 30-year note. Never missed a payment. And they wanted to buy this house for their future son-in-law and their daughter. What a hell of a wedding present, right? And they were going to assign the mortgage to them after they got married, but also back them, be co-signers on the mortgage with them. When they went to Chicago Savings and Loan, they actually saw a loan officer named Francis Tomasello, who was a neighbor, but west of Western, in St. Rita Parish, the same parish. And Francis Tomasello said, Emily, I'm sorry, I have to tell you, but we're not lending there anymore. Emily said, what do you mean? My mortgage is there. She said, well, no, now it's an FHA neighborhood. She said, what does that mean? She said, well, we'll only consider making loans that are guaranteed by the federal government through the Federal Housing Administration. Now, this is 1971. This is 5 years after the civil rights victories, right? The Civil Rights Act here in Washington. And so Emily told this story, and I went up to the easel pad, the organizer role, right? And I said, okay, Western Avenue. And then we drew out the streets on both sides. We said, what's different between east of Western by 2 blocks and west of Western by 2 blocks? We looked at schools, same schools. We looked at churches. We looked at healthcare. Holy Cross Hospital served that whole neighborhood. We looked at retail. Western Avenue was the retail corridor. It served both sides. We looked at parks. We looked at everything. Everything was the same. You know what was different? Anybody want to guess? Say it again. Racial demographics. There were 4 new black families who had just moved into the neighborhood east of Western Avenue. That was the only difference that we could discern. Again, this is 1971. And by the way, within 3 years, that whole neighborhood shifted from white to black. There was blockbusting and panic peddling. There was arbitrage through what we call double sales, because when white flight took place because of bigotry or hatred or fear, realtors panicking whites, moving out, buying the houses themselves, marking them up by 25% and selling them to African American families in those days. This stuff really, really happened. And so we learned about disinvestment. We learned about urban disinvestment. We tried to meet with the hierarchy of Chicago Savings and Loans. They would not meet with us. We actually started to hear other stories from other financial institutions. Tallman Savings was there, Market Bank was there. And we went, and Tallman actually sat down and met with us, and they said, yeah, we are disinvesting because everybody's disinvesting, and if everybody disinvests, then our fiduciary responsibility is compromised in this neighborhood. But we're very willing to talk about what can we do to preserve this neighborhood so we can all compete in the neighborhood. So there were some lenders that were reasonable to talk to. Chicago Savings, by the way, they ultimately did talk to us, but to get that first conversation, every weekend we delivered 300 to 600 people to their lobby. Mm-hmm. We got people in the teller line. Well, they went and opened new accounts, and they got into teller lines and closed the accounts, and they went and opened new accounts, and then This was a long time ago, right? But it brought them to the table ultimately. And all of those banks and savings loans ultimately came together with the Southwest Community Congress and started something called the Greater Southwest Development Corporation, which was a CDC in the neighborhood. I was the executive director of the CDC for 35 years in that neighborhood, but I had a little lapse between those two jobs. Because later in 1971, after going around the city and understanding from the Northwest Community Organization, the Organization for a Better Austin, I won't rattle them all off, this was happening everywhere where the inner city of the neighborhood, the inner city of Chicago was trying to expand, where people were trying to buy homes in neighborhoods around the cusp of the inner city. Austin was such a neighborhood. Near Northwest Side was such a neighborhood. Redlining, we didn't have that word at the time. Discrimination in lending and terrible real estate practices were happening in all of these neighborhoods. There was a whole lot of money being made by realtors on those double sales in those days. And so I went to work for a woman named Gail Sincata in Chicago in late 1971. And at that point in time, we were working on the passage of the Home Mortgage Disclosure Act, which wonderfully was put up on the board as a data set that we can all depend upon. There was no such data set in 1971. The only knowledge we had was anecdotal knowledge that came in from real life examples when people felt the sting of discrimination and felt the threat of neighborhood deterioration and ultimately desolation in those neighborhoods in Chicago. And so we organized and we passed the Home Mortgage Disclosure Act. And then we got the data, reams, I mean, not punch cards, but something like punch cards. Mm-hmm. I remember actually driving with Gail to the University of Chicago, to the Harris School, and delivering it to a team of graduate students who analyzed it. We looked at all of those neighborhoods, and like the graphs you saw earlier, we had conventional lending going down, and we had FHA lending going up. And the only other kind of lending that existed in those days was contract sales. Mm-hmm. And there are lots of stories about that, right? And so those were the early days. And once we had the data, once we had something above and beyond anecdote, we could actually mount a national organizing campaign that in 1977 caused CRA, which is now 40 years old. But it wasn't always there. It led to a lot of things. It led to a lot of good things. One of the things it led to is the National Association of Affordable Housing Lenders. Back in those days, there wasn't a group of collegial professionals in disparate financial institutions who all had the common goal to cause neighborhoods to revitalize and people to benefit. I don't think you would be here if it wasn't for that. And so that was my task, to go way back to the beginning. I'll put my 30 pounds back on, and I'll sit down. Thank you.
That's great, Jim. Thanks so much, Jim. It's great to kind of feel the weight of that story. And then looking back on it, we can feel grateful about your work then and the creation of the CRA. And at the same time, I can't help but feel a little bit of discouragement that so many of these issues are still pressing today, and we're still fighting many of the same battles. That's a great setup for our conversation about what's working and where do we go from here. So let's start our roundtable discussion. Thank you again, Jim, for kicking us off. So on our first question about what has worked, what do we want to preserve about the CRA? Robert, let's kick off the discussion with you.
Sure, and I joined the bank in 1995, the first major revision to CRA, so significant changes since the establishment of the statute. One of the things that we really appreciate about it is the mission, the fact that there's a focus on communities. And meeting the credit needs of the communities. I think that is one of the main tenets. Mm-hmm. I think a lot of us are involved in this work because of that. And the other thing I like about it is the fact that it's not prescriptive in terms of being a statute like some of the other regulations that banks have. There's a lot of flexibility there. We mentioned the fact that, as Jim Matthews from Capital One said, flexibility and having consistency, they're not mutually exclusive. And one of the great things about the flexibility is there's different types of institutions, there are different types of needs in these various markets, and it really allows a bank to maximize on its strengths. You know, what types of resources can it bring to bear to help meet the credit needs in those communities? So that sort of flexibility, I think, hopefully would continue going forward as well. Another point I want to make about the changes in 1995, prior to that, the way that banks were being measured in terms of their performance was that regulators were looking at processes. You know, did they send out forms to get filled out? And then it turned into a much more quantitative exam where the focus was really on numbers. But that was great because then at least the public can have a better sense of what a bank's activities were in a community and what that resulted in. I think, you know, CRA is going to continue to evolve. Sometimes that exercise has become a little too mechanical, and
the exam process itself.
Yes, the process itself, and we lose we lose sight of, you know, how challenging, complex it is to try to meet the needs within the communities. So that's the other thing too. The flexibility, I think, should continue forward.
Yeah, good. Others on what should we preserve about the CRA? What's worked? Yeah, Rafael, go ahead.
You know, John, I loved, Jim, your story, and you know, I have the good fortune of leading an organization that is older than CRA, which is interesting, and it is a 43-year-old organization that is focused on bringing capital into underserved communities, focusing around housing and community development. And you know, I think for me, the answer to what should be preserved about CRA is frankly really simple, and that is the capital that has flowed into communities because of CRA. My organization alone, having grown up in the CRA era, has been able to funnel almost $10 billion into New York State's neighborhoods over that time period. You know, we could argue about whether or not that would have happened or not, but you know, having grown up as a professional in New York City in the late 80s and listening to Jim's story, I think we kind of know the answer, which is that CRA was the impetus for that capital to start to flow. And so for me, when you think about as a practitioner, as someone that is a user of the CRA capital and has been for my entire professional career, I think we have to remember that capital was flowing out of communities prior to CRA, not into communities. And capital has been flowing into communities, and we have debates in New York, my home city. We have debates in New York all the time about gentrification and affordability and all of these things. And you know, I try to focus those conversations around, it was just 1986, a short time ago, and New York City's neighborhoods looked vastly different than they do today. And the affordable housing opportunities and the quality and decent and safe housing opportunities for low and moderate income families in New York City were vastly different than they are today. And that's because of CRA. And I think we have to, you know, keep focused on that, you know, on that primary target, which is making sure that capital continues to flow and serve the needs of the communities.
Good.
In 1986, I was a junior at Columbia University. So I walked around the neighborhoods in New York City, including Harlem was very close to Columbia University. And New York, indeed, is a very different place than it was in 1986. And I think some of that is due to CRA, and now we have to make sure that there's prospects for integration as we do grapple with forces like gentrification. In 1977, to date myself, I was getting my bar mitzvah. when CRA was passed, and I did not know about the CRA. And I came to NCRC in 1995, right after the reforms to CRA. So I've been around CRA professionally for about half of its life. And I'm glad to be working at the National Community Reinvestment Coalition because I think NCRC has helped preserve and strengthen the Community Reinvestment Act, and in a very collaborative way with financial institutions. I'm sitting next to Gwen Robinson of Santander. Just this week, the National Community Reinvestment Coalition in Santander announced an $11 billion community benefits agreement. That these agreements arise in the context of either bank mergers or CRA exams, discussions with financial institutions about how they can improve performance. And Santander has made significant lending and investing promises in their footprint. Since CRA has been since its inception, financial institutions have made $6 trillion of CRA agreements or community benefits agreements. We know that works because Federal Reserve economists, including Rafael, who's now president of the Atlanta Fed, he spent a summer in our conference room looking at the CRA agreements, and he documented that, in fact, lending increased after signing these CRA agreements. Let me throw a couple of other statistics. I also want to talk about intermediate small banks, banks with assets between $307 million to about $1.26 billion. We just released a report this week. Because of their community development test, over a 3-year period of time, they make $9 billion in affordable loans, affordable housing loans, and economic development loans. This is $3 billion a year, which is about the same level of the community development block grant. So we think it's very important, and a lot of intermediate small banks know that doing well by communities means they do good in their bottom line. So we actually want to preserve the community development test for these institutions. CRA is indeed a push. There's a lot of other data. It's kind of like climate change. Overwhelming number of studies, 90%, more than 90% of scientists believe that there is climate change, but CRA, in a way, it's the inverse. CRA is a positive force to revitalize neighborhoods, and I think the evidence is overwhelming that CRA has made a profound difference. Some of you are probably aware of this. HUD, the Cityscape publication, has looked at the 40 years of CRA history, and people like Rafael have documented that CRA indeed has increased small business lending in low and moderate income neighborhoods. 24 million small business loans in low and moderate income neighborhoods by banks. And just this summer, the Philadelphia Fed released a study to say if there was not CRA, lending in low and moderate income tracts and to low and moderate income people would be about 20% less. And to put a number in that, over a 3-year time period, there would be 100,000 fewer home purchase loans. 100,000 fewer home purchase loans. To wrap your head around that, that's about the size of Green Bay, Wisconsin. So imagine no homeowners in Green Bay, Wisconsin, a state that did go for the current president in the last election. So CRA positively impacts all communities, whether you're in a red state or a blue state, a rural area or an urban area. And collaboration is one of the huge benefits of CRA, working together.
Good, that's great. And thank you especially for bringing up the intermediate small bank issue. I mean, I think one of the risks of this overall CRA reform conversation, but like even in this room, like the conversation tends to gravitate towards the larger institutions, and we forget about the really meaningful impacts that a smaller institution can have on its local community. So I'm glad that's part of our conversation. So, Gwen, what would you preserve or keep, or what have you found important about the CRA?
I'm not going to go back and do the reminiscing all the way back to the 70s.
How old were you in 1970?
I was young. I was more than a toddler, but not elementary school. And I didn't join banking until 2005, so I spent the first part of my career in community organizations. I was an IEF organizer, and in the late 90s, worked in Atlanta on a research project around home improvement lending, where you still had to pull deed records and plot it on a map. So I think when we get to the what can change about it, the whole, the ability to do more data analysis, I think is so crucial. But I work for a global institution that the US is about 10% of our global markets, but they have a corporate social responsibility agenda that's around financial inclusion. And I think one of the most important things about the Community Reinvestment Act is that it sets that standard in the US, and it sets a standard where a banking license is a public trust, and it's our obligation to serve everybody in our communities in a safe and sound manner. So it sets that framework up where it's not a debate. It's something that we know we have to serve, and when the market can serve it, when we can serve that through our products, I think that's the ideal. When we can't meet those needs through our products, that's, I think, where the community development industry has developed. And so I think it's really important that it sets out a clear role for financial institutions, but that role is very much dependent on public policy. I see Wendy in the audience. She and I both worked at New York DFS as regulators, and I think the public policy aspect of CRA, the regular evaluations, the fact that it's the only compliance exam that's public, is crucial because it allows for that interplay of community organizations, public agencies, and financial institutions in creating change, because banks are certainly not able to do that by ourselves. I think the very first redlining maps were used by banks, but they weren't created by banks. They were created by public and quasi-public agencies. Mm-hmm. So if we want to have changes in outcomes for low-income families, for communities of color, we need to have more and better public policy that recognizes that CRA is a tool, but it's not a tool that's going to solve all problems.
Great, thank you. So Jim, as you look back, is there anything you're particularly proud of that the CRA has lasted this long and all that it's accomplished?
Actually, there's several things that I'm proud of, but they all kind of have a similar theme. 1979, I had my first meeting with somebody representing LISC in Chicago. And LISC is a great institution. Thank you for being the biggest sponsor, I guess, of this conference. Yeah. And I know that Mike Sverdoff at Ford had a really good idea, and Ford put some money behind it, but then CRA, that must have happened right around the time that CRA was cooking. And so the convergence of a really good idea with some philanthropic money going into this nascent organization called LISC, and then all of a sudden, all the banks and savings and loans in the country are looking at how do we get money into inner city neighborhoods? Yeah. How do we get money into low-mod census tract? And it was that convergence that created, you just used the word industry. We were not an industry then. We were a bunch of ragtag people saying these neighborhoods are important, and while sprawl was taking over all the metropolitan areas. So I could point to LISC. And earlier I pointed to this organization. What I'm most proud of, I think, is to be a collegial member of now a super large cadre of professionals who think this is important. And, Josh just said, I was on Josh's board when I was the Woodstock president for 6 or 7 years in the 90s, who think that this is really, really important, not just because you'll do well by doing good, but because they really care about doing good as well. And that surely wasn't true way back when in the 1970s. And so I think from a kind of a moral compass point of view, we're pointing at true north. Now, I still have some ways that I'll save until your next question on what could we do differently with CRA, but I think there's a lot to be proud of.
Good, great. Okay, good. Well, now it's time to get to the fun stuff. So CRA, I don't think anyone would disagree, has been a headache in some respects on both sides of the table, despite all the wonderful things it's accomplished. And there's some work to do. And some of these issues have been known for many decades, and yet we're still working with that 1995 rule that we've been talking about. So let's get to it. What needs to be fixed? What needs to be modernized? I want to start with Josh, because you have spent a lot of years thinking about the CRA deeply and writing about it and researching it, and have put forward a number of recommendations for what a new CRA should look like. So let's start with you. So what needs to be updated?
Well, thank you so much, John, and hopefully we can work together to do some of these things. But I was listening to the comments this morning, and I would say first, the Hippocratic Oath, do no harm, because there is a lot good about CRA. And one thing I would mention is I would like to have a dialogue with Greg Phillips directly at one point, because I don't quite understand some of the logic that you're afraid of a downgrade on the fair lending review, so you're only going to shoot for a mediocre rating. Well, if you get a satisfactory rating and then you might get a downgrade, you actually fail your CRA exam. So we've heard the opposite, that we've heard some lenders saying, I got to shoot for that outstanding rating, because if there's a fair lending problem down the road, I still pass. Most likely I'll get a satisfactory rating if I get a downgrade. So that one thing we do need to keep in mind, that some of these mechanisms are, maybe they need tweaks, but the essential core mechanism in a way does work. But one of the big things I would say for change is assessment area, and Craig Phillips is talking about assessment area. And I was actually heartened by Neil Buddha's statistic that 70% of a bank's bank home lending is occurring through assessment area. And actually, NCRC found, we did a report a few months ago on assessment area, and we had a similar finding. So assessment area is still working in a good number of cases, but we know about fintechs, and we also know about lenders that are using non-branch mechanisms to make loans. I got a refinance in a shopping mall one time. So how do we account for that? I don't think it is as hard as people think, because there actually are some existing CRA exams that do this. There was a Citicorp exam a few years ago. There is a OCC exam of an online lender, where the exams actually go beyond the branch networks, and they find geographical areas where there's a high volume of lending. And they say, we're going to kind of make this a quasi-assessment area. We're going to assess lending in geographical areas where there's a high volume of lending. It makes sense. It's actually a previous Capital One exam. Jim Matthews may know about this. But I would like a little more teeth in those instances. It didn't seem to be any impact on the rating after the evaluation of these areas beyond assessment areas. I would just make them assessment areas. And I'd also be careful that you just don't end up adding urban areas, that you also look at smaller cities and rural areas that may not necessarily have a high volume of a particular bank's loans, but the bank may be important in that rural county or smaller city, maybe like the #2 lender. So you want to make sure that you have a diversity of assessment areas, because we do have a problem right now with full scope assessment areas. They tend to be the larger metropolitan areas. And we do have a problem, not only the rural areas, but like the cities like Dayton, Ohio. That's pretty populous, and one of our board members works in Dayton. Oftentimes, it's not a full scope assessment area. Now the regulators did say to us at our conference last year, at a workshop I ran, that if community groups are commenting about these things, then Dayton may be an assessment area on the exam the next time around. So I think that actually we can do a lot of this through CRA exam practice and procedure, and not even necessarily have to go through an entire regulatory rulemaking. But I do think there is some consensus that there does need to be a reform for assessment areas. Banks also have an issue about where am I going to do my community development investing in affordable housing. Well, if you get more assessment areas where there's retail lending outside of branch networks, hopefully the community development lending and investing also becomes a little easier. So anyway, I have further ideas, but I'm going to stop because we only have like 2 or 3 minutes we're supposed to talk.
Yeah, right. Yeah. We got to fix the CRA in the next 5 minutes.
Which you can't do in 2 or 3 minutes.
I do want to spend another minute on assessment area, because that does seem to be kind of the crux of what has changed in the industry and the crux of what needs to change around the CRA. And I did want to follow up with you, Josh, on this question about community development. If you think about an online lender, to me, it certainly makes sense. Like, okay, there's a big cluster of loans in Dallas or Chicago or whatever area, so you might be concerned about whether that lending is happening equitably to LMI borrowers, LMI geographies. But But to have community development then have to follow that, does that online lender located in Salt Lake or Silicon Valley or whatever then have to fly people out to Dayton to, to go meet with a local community group, or fly to 50 places around the country to do community development?
Salt Lake City, Utah must be one of the best places to have a CDC.
True.
Because there are so many limited purpose
For
banks.
many reasons.
Well, it's a beautiful place too.
Yes.
I've been to Utah. But there's so many limited purpose and wholesale institutions, and now fintechs want to locate in Salt Lake City. And I take nothing away from Salt Lake City, but I also want to make sure if you are a large institution that you have CRA and you happen to be headquartered in Salt Lake City, but you're a branchless bank, or you're a branchless bank, so why should your only obligation be to Salt Lake City? So I would answer this in two ways. Actually, Lending Club, which is a fintech, actually puts its lending data on the internet. It's not HMDA data, but at least you have some data of location. And I actually looked at Lending Club's data, and I found there was a lot of lending in places like San Antonio, Texas, and some of the big cities, per usual. So I would make some of those assessment areas for Lending Club. I would also make some rural areas assessment areas for Lending Club. We've actually had discussions with Lending Club. But also, suppose you have a branchless bank. Take a crude hypothetical example, 50 loans in every single state. Mm-hmm. What do? Does the whole country become an assessment area? I would like the regulators to do some thinking. The San Francisco Fed has done some thinking about performance context, and the Atlanta Fed has some interesting tools as well. But can we do this a little bit with underserved and distressed census tracts? Mm-hmm. These are census tracts that have, worst case needs, or pressing, I prefer the word pressing needs. Can we develop maybe counties across the country that have pressing housing needs, that have pressing needs for job creation because unemployment rates are high? We can use our census data, and let's preserve the census data, and other data to create a list of distressed county, or counties that have pressing needs. So for these lenders, it just seems like it's kind of the activity is kind of uniform across the country and maybe not higher volume in any one place. You could identify higher pressing needs counties that they could do the community development lending and affordable housing in those counties. You don't want them just to go anywhere, because if they just go anywhere, just like a human being, like I would, I'd do something that's easiest for me, right? I was maybe a little bit better in math and Spanish when I was a kid, right?
Can I just build on what
So I'm going to stop there.
Yeah,
Absolutely.
so I think let's spend a minute on assessment. I would like to hear others' thoughts on assessment area, how that needs to be modernized. Gwen, were you going to jump in?
Well, I was going to say if you take a step back about what you would keep yet change, I think the carrot and the stick aspect of CRA works, but the carrot with the downgrade issues, and we're very appreciative of the new guidance from the OCC. We wish it had happened a little bit earlier. But I think what you're talking about in terms of the community development activity is part of the flexibility that we appreciate about CRA, and there are other ways besides being very technocratic. I think one of the challenges about CRA is that when you know the rules, it's very easy to go down into a rabbit hole of all of the different technical ways of how you meet a specific statistic on the lending test and the statistical evaluations. Yet the community development side of the house really is sort of more open to some of those big ideas. And some of the simpler reforms that I know people in the audience have worked very hard on in recent years, like regions. Let's make the statewide and regional area credit more clear, easier to work with. We're in the Northeast, and our regional area would include places like upstate New York. If it were clear and happened in practice, that we knew we would get CRA credit for that kind of transaction when we were going to engage in the transaction, not when the exam started, which may be several years later. So I think there's technocratic reforms that we could make, and then there are just, I think, clearer, simpler rules has been really a drumbeat from the banking industry, because we all are on board with engaging in the activity, and we don't like being in contentious conversations with community groups around the specific rule about how we get CRA credit, because that's just, it makes it seem like we're kind of nitpicking, but it is very important to me. I have a limited amount of capital that my business is going to be able to invest over the next 3 years. It sounds like a lot, but believe me,
It's a big
people are
number.
calling. And I think we'll have it well allocated on the community development side. But if it's a choice between a transaction where I know we're going to get CRA credit, I know there's a big need in New York City, and one where there's an equally good need in a rural area, but I'm rolling the dice. I'm always going to choose the transaction where I get CRA credit, not just because it's easy, but because that's in the best interest of my bank.
Right, and it seems like the rules of the road need to be known in advance.
Yes.
Right, yeah, Rafael, you're going to jump in.
I'd like to piggyback on that because, as a practitioner, I'm not a CRA banker. I don't really know from assessments and all of that. As a practitioner, I've heard words like flexibility, transparency. People like that about CRA. As a practitioner, CRA often feels like a straitjacket or a fishing expedition. Unless you are a low-income housing tax credit deal, you have to figure out how you thread the needle when it comes to affordable housing, which is my business, and we often find ourselves in that fishing expedition about, does this fit, does that fit? Well, we can't fund that, we can't fund that. My underlying agreements with our lender group have very specific covenants about, a certain amount of deals have to be for this and have to be in these communities. And that becomes a very difficult thing to manage when we have lenders in communities, in neighborhoods all across New York State. We know what an important and impactful project looks like. We know how to test that. We know if it's what the community needs, if it's what the community wants, if it's what the city is saying we need to do, if it's serving the right population and the right people for the purposes of that local municipality. But that doesn't really play in the CRA context. So I mean, from my perspective, I'd like to see more flexibility. I'd like to see more openness, right? I get it. Assessment areas is part of that, so that you can go to Buffalo even if your primary assessment area is New York City. But I think it's bigger than that. I think it's kinds of projects. I think it's not just having the getting credit for subsidized affordable housing. How about the recognition that most low and moderate income people in this country don't live in subsidized housing, nor are they ever going to live in subsidized housing, because there's not nearly enough subsidized housing being produced to actually serve that population. So how do we open the doors and open the minds a little bit so that it's not just, I'll pay as high a price as I can for a tax credit deal in my assessment area, and then everything else is, as you say, it's kind of like, well, I don't know, maybe I have a limited amount of capital, I might not be able to do it. I'm not sure I'm going to get credit for it. Last week the regulator said I would get credit for it, but next week they may not. Or next week the regulator might be different. The person that comes in might be different, and they may not see it the way the last person did. So that straitjacket and fishing expedition is the way it's the way it feels to us, is the kind of thing that I think holistically needs to be changed about CRA.
Yeah, great. So Jim and Robert, you're both waiting to jump in. Jim,
I
why
have a
don't you?
question for Gwen after.
So,
Okay,
so
I got you.
I want to expand on that.
No, it's okay.
It's called the Community Reinvestment Act, not the Housing Reinvestment Act. And a long time ago, we didn't mean for it to be the Housing Reinvestment Act, although the anecdotal information we had was mostly about housing, because that's what our folks were looking to borrow for. And the change came in the mid-90s, and small business lending was bumped up. The people in this room, the people in our industry across the country can tell you 100,000 ways to do a low-income housing tax credit deal, and how to package it. I won't. Jack Markowski from our town could probably give you 100,000 himself. We don't really have a good definition for the words economic development. On the call for this panel, I said, one of my frustrations is that we don't deal with economic development. And a question came to me, oh, are you talking about small business lending? or retail revitalization. And in a conversation with Jack earlier today, I said 10%, maybe as many as 20% of the retail revitalization projects that I've seen actually qualifies economic development. The rest are good for the neighborhood, but they won't grow the economy. And if they don't grow the economy, the problem with poverty is there's not enough money. Where do you get money? Not there, because there ain't enough to begin with. Most retail serves each other in a neighborhood. What's the export strategy? I remember sitting with the Bailey CDC maybe 15 years ago in Detroit, where the International Bridge comes down in their neighborhood. And we're talking about housing projects, and I am just distracted by the window watching this endless flow of cars come off a bridge. So finally I said, how many cars from Canada come from Canada here? 350,000 a week. Wow. If 10% of those cars stopped and spent 20 bucks each, right, that's an export economy, right? We have no way to think about that, and we have no discipline to put on top of that. And so I would say we're really smart people. You know, and the research that we saw in the earlier panel shows that we're really smart people, but so far all of our creative thinking is focused directly on affordable housing, which is a wonderful thing. I'll end with this. I was in Toledo about a year ago to do a strategic planning retreat. The United Way, the county, the city, LISC of Toledo, a couple of major foundations. And the guy from the housing department of the city of Toledo was really in a bind because he had no more chodos to work with because of the 13 CDCs in Toledo. 12 went bankrupt. They're gone. One still exists, but it's on the ropes. I said, why are they on the ropes? They said, well, they tried economic development. Well, what does that mean? Well, they started a retail business, a restaurant. And they said, I said, let's go back in history. What were the assumptions when all these CDCs came about? And they said, well, we thought that if we housed people in decent, affordable housing, good thing, that they could assimilate into the economy. But the problem is the economy went south while they were building the housing. That the folks, Toledo was a town that supplied the Detroit auto industry. And so the folks who had those businesses either moved or closed or whatever. And so, you know, I think it's time for a fresh challenge. I think it's time for us to actually find another prize, one that every neighborhood that was ever developed had an economic reason to exist. Chicago hog butcher of the world. Back of the yards was back of the stockyards. We were the hog butcher of the world because the railroad allowed us to bring cattle from the plains, slaughter them, put them on a freezer rail car that George Pullman invented, get them to the East Coast, and sell beef and pork in France and Great Britain and Italy. Hog butcher of the world. It was all based on an export economy. That's why my grandfather came here from Italy, because there was that kind of opportunity in a working class neighborhood in Chicago. We don't know how to do those strategies, and we dabble at the edges on those, but the bold move is still out there, and I think that we are smart enough and capable enough to figure that out.
Good.
You know, before we
go ahead, Robert. Yeah,
take those bold moves, I'll bring us back to the current process. And one of the challenges that we have and is around whether or not we're really addressing the credit needs in our assessment areas adequately. Because if we had certainty around that, then I think we would engage in more innovative approaches, or we'd go into markets where the need was greater. Unfortunately, we don't have that clarity. We don't have that consistency. I was just talking with a colleague of mine because I guess our line of business partners were talking to one another to see whether or not they got credit for the same transaction that we did or we didn't. So that's the kind of inconsistency we're experiencing. And one of the things that's frightening with some of the proposed changes in terms of the assessment of CRA is these qualitative factors are going to be taken into consideration in the new exam procedures. which require a lot more judgment and, in my mind, a lot more experience in order to make those calls. I think it's a great development because I think a lot of those qualitative factors have been undervalued in the past, and they really provide a comprehensive story of what that impact is. But if we're not even clear on some of the quantitative measurements, then going into this uncharted territory, taking qualitative, more subjective elements into consideration, and then trying to explain this internally, with senior management. I mean, one of the most frustrating things is when you look from exam to exam, and the results are either comparable or even better, but yet you see a downgrade in a rating, and you can't understand or explain it, and try to explain that to your executive management if you're supposed to be the subject matter expert. That's the challenge. And so I think to the extent that there can be more consistency, standardization, clarity.
Yeah, and the qualitative part is interesting. I mean, we could probably have a whole nother panel on just the administration of the CRA. Just like if the rules are what they are, how do we develop a performance context, and how are examiners?
John might be the only one who would be awake.
For that training? Oh, for that panel? No, I think it's fascinating. I mean, I have always felt a little bad for CRA examiners who get trained in great detail on the regulation and how to write a performance evaluation and exam procedures. And then they arrive on the exam and they're expected to make these really nuanced judgments about what is going on in this community, what are the community needs, is this an innovative financing instrument? That takes a lot of background and knowledge on how this field works and how financing works, what's going on in communities. And I feel like there's a lot of work to be done on helping those examiners make those judgments.
John, one thing I would say, though, to help make better qualitative judgments is actually better data. Jim, you were talking about this is not the housing reinvestment. In some ways, you're a victim of your own success because advocates in the 70s were very effective in bringing forth the issues of affordable housing. Right. But there's a huge need for small business financing, for example, and that is kind of the poor cousin, even on the retail lending test on CRA exams. And one thing that would help improve and motivate banks to address small business financing is actually better data. The Consumer Financial Protection Bureau is starting the process. It's called Section 1071 data, and would give us more demographics of the small business borrower, including the race and gender of the small business borrower, but also how big the small business is, whether it's really a micro business or a larger business. And so I think in general that data would be helpful. And also there's been a lack of data on community development, investing, and lending on CRA exams. I mean, you get reports about, in an aggregate sense, about, this bank made $10 million of affordable housing, or $3 million of an investment in an SBIC for small businesses. But if there was even data on a county level for the number of community development loans and investments, and it was a centralized database, you could figure out the counties that had a relatively good amount of community development lending and investing, and the counties in the country that need more. And that could inform, going outside of your assessment area. That could inform, those types of decisions. And lastly, Gwen, this is a good question because I don't quite understand it. You said ask me on the side, but actually I think this is a very reasonable question because I don't understand it. When you look at the exams, and I looked at the exams of the largest lenders, Wells Fargo exam actually said, Wells Fargo did an excellent job in the statewide areas and the regional areas outside the assessment area for community development lending and investing. That positively influenced your exam. You look at the other big banks, and they were very similar questions. So from an advocate, it seems like this happens all the time, that you get credit in the statewide and regional area. So we have trouble figuring out why is there still complaints? And maybe one reason is you have to wait for the CRA examiner. I mean, the question is, do you have real-time conversations with your regulator and your examiner,
I think,
during year 1 and 2? It's like, hey, I want to do this thing in upstate New York. Will they answer that question? That would help everybody, the community groups and the banks.
Yes, it would. And while there's public welfare definitive responses that you can get if you submit a pre-application. There's no regulator will answer the question beforehand. They want to reserve the right to come in at the exam and evaluate it in the context of all the activity. And I do think that it is a constraint. I also think that positively influenced is not a quantitative measure. Like, what does that mean? How much did it positively influence it? I know that it is going to influence it if it's in the numbers of my assessment area tables. I don't know how much weight the statewide and regional. Is it influencing it in the margin? Can it, lift an area up a complete different area? I did want to go back and just respond to Jim's point around economic development. One of the things that I think is great about CRA is that it has a clear focus on low and moderate income families. Like, it's a clear focus, and I think the housing industry has done an excellent job of setting up an entire regime of tax credits, private sector financing, annual income verification. We know that housing is helping low and moderate income people, and we know that I think housing is one of those areas, having started my career in organizing and then with the Annie E. Casey Foundation, where there's a lot of conversation about outcomes. And if anybody's ever been tortured by a funder around a logic model or the difference between an output and an outcome, like, I think that housing doesn't have the same kind of rigor around it around outcomes, because it's very intuitive to everybody what a good, safe place to live means on a family's life. Economic development, we would love to have more opportunities to invest in economic development investments if I knew that low and moderate income people were actually going to benefit from that investment. There are some SBICs where it's as of right. I know I'll get CRA credit, but is it a good use of my dollars? Because do I know, it's hard to get reporting on what were the net jobs created or retained. There are very few economic development investments, like DBL, that actually does real reporting on what's the net jobs impact. What are the wages of those jobs? So I think there is room for the industry to improve and more creativity. And again, for public policy, none of this happens in a vacuum. Think of how long it took for the affordable housing industry to develop and how complex it is. I completely agree that kind of creativity and thought needs to happen in economic development.
Good. Well, we've covered a ton of ground. I know we've brought up a lot of different topics, but we have a little bit of time. We'd love to have questions, comments. What are your answers to our questions about what to keep and what to fix? There's maybe we can. I know Paul's in charge. He's got the microphone.
Getting good workout too.
Yeah,
maybe we start with Tommy.
10,000 steps. What does your Fitbit say?
All right.
Outcome measure.
Tom Espinosa with the Raza Development Fund. I beg to say that housing is an industry that I think we've all tied down. I mean, I run a CDFI, so obviously that's an area of ours. But I would really argue that economic development is the only vehicle that's going to really impact poor families. So when you start getting into this space, I think we need to start thinking out of the box. We're going to do housing deals all day long because all of you just said it. It is an industry that's so tied together that it's pretty easy to get those deals through. But the reality of our communities is that if capital does not go into the business sector, we're always going to have poverty. So the argument that for banks, I think the argument that I keep hearing is it's difficult to underwrite a small business loan. They're too risky, it's too high. Well, yeah, but at the end of the day, if we figured out the housing part of this industry, then I think we can figure out the economic development side of the business development in poor communities. And I think that's really where the change on CRA could really have an impact, especially in low-income communities, predominantly in Latino areas. I would argue that those areas have been the ones that are growing, especially amongst Hispanic women, creating small businesses that are hiring folks right there in the barrios. So as we start to look at CRA and the window of opportunity to talk to Treasury and to talk to the regulators and obviously to the banks, I think it's time that we start thinking out of the box as it relates to CRA economic development. Thank you.
Great, thanks, Tom. Other questions? Who's next?
Yes.
It's on, they'll do it for you.
A question about rural America, in that we've just heard a lot about the cities across the country. But for those of you who've traveled in Western Pennsylvania, for example, or some parts, many parts of the country, that in 1977, when CRA was passed, were very healthy communities, and they're not now. So I wonder if you could talk about the spectrum of how you see things happening over the course of the changes in CRA that will improve not only the housing, but the economic development in rural America.
One thing is, I would say, is that reforming full scope and limited scope assessment areas, because rural areas tend to get the limited scope designation, and believe me, it's a very, very cursory look. And also, I would like to, I do hope we can involve and improve this real-time communication issue, because there's a difference between saying nothing and saying, okay, this will definitely, this will definitely count in your exam. I mean, they could at least give you some sort of guidelines. So it sounds like they're giving you nothing right now, and I think they can give you somewhere in between a nothing and a definitive answer that could be helpful.
I'm not going to go on record saying they're saying nothing.
Okay.
But let's stay on the rural.
I think this is kind of nub. It's an implementation
but I-
issue.
Let's say, hey,
there's
time out,
choosing.
time out. I'm the moderator.
No.
I get to decide. Let's stick with this rural question,
I
because I
do.
think it's really important, and maybe it's not immediately obvious. How do we get that flow of capital into more rural
I will
areas?
throw it over to Robert, but I do want to just respond to that. I do think that kind of rotating the areas that are full scope, having more regional activity will help increase resources to rural areas from the private sector. But I don't think we have, Reading, Pennsylvania was our Northeast Bank's headquarters when it was formed. Reading, Pennsylvania is a town that was the center of the hosiery industry. It's a place where the town fathers directed the Pennsylvania Turnpike away from the city, similar to Winston-Salem, because they didn't want outsiders coming in and messing with their labor market. There's a lot of things that go into economic development that are kind of shifting resources to Reading is not the only thing that's going to help create a new economy there. So I do think that if we can't find a housing deal, an economic development deal, the flexibility to be able to direct grant resources to invest in capacity building, I think can help create that environment. But CRA, again, by itself is not going to help bring back both rural areas and smaller cities that are deindustrializing. It's a bigger picture of the kind of economic change that's happening in America.
Yeah, that's good. So Robert, let's go to you. and then
I
Rafael.
think this is one of the areas where CRA can be enhanced going forward, is if we looked at the types of activities that can qualify. Rather than wait for, 4 or 5 years before the Q&A gets updated with new types of examples, maybe as these types of activities, banks begin to engage in these. For example, we actually just did a new markets tax credit investment in rural Minnesota to offer broadband service, because not only are these communities unbanked, but they don't have access to the internet. So those types of activities, if we can more frequently add to the list of what types of innovative approaches, responsive approaches to what some of these needs are, especially in some of the underserved and rural markets, I think that would help.
That's great. And Rafael, you work in different types of
Yeah, I mean,
geographies.
what I was going to just add, I mean, we work all across New York State, which is a very big and diverse place, and we work in a lot of rural communities. We're working in a lot of small cities in the so-called Rust Belt. And I think clearly, like, this is part of what I was saying before. We sometimes have trouble with this whole issue of assessment area in some of these places. But by and large, I actually what we experience and what I experience, having grown up in that part of New York State as well, is that the issues and challenges around those communities are much bigger than CRA. And it's about jobs, and it's about a focus of resources to try to find new technologies and new industries that are willing to go into those places. You know, in our state, you know, our governor has for the first time, you know, in my lifetime in New York, really focused on those kinds of communities and focused on how do we bring jobs to the southern tier and how do we support, you know, a beer and wine industry that is based in some of the most rural parts of New York State, and how do we try to ensure that that grows up in a way that can bring more jobs and support those towns and communities. CRA can be you know, and improving the credit availability can be a support to that kind of activity. But I think this larger question is a larger question that frankly played out in the 2016 election of communities that have kind of been forgotten more broadly, and I think we all need to spend some time thinking about what are the things we need to do to try to bring some of the prosperity that frankly even upstate New York cities, Buffalo, Rochester, Syracuse, Utica, those cities are starting to see a resurgence because more people want to live in cities. Jobs are being created in those places. But it's the smaller towns and smaller communities outside of those urban markets that are still struggling.
Yeah. And Jim, this goes right back to the point you were making about generating that economic vitality.
You just stimulated a memory and then a thought based on that. Broadband, new market tax credit deal for broadband. The information superhighway, right? In northwest Illinois, from Wisconsin down through Quad Cities area, that whole swath. Rockford's in the middle of it. It's a major urban area, but a lot of rural area. There's an organization that's been working with crafters, women who quilt, they make things, right? And they were bringing the crafts work to Rockford, Illinois, because it's a city with a big market, constant. So people would produce on their farm or in their small town, and they would bring it to the municipality for access to market. And once they started doing that, public housing residents in Rockford then got into the mix of crafters. And the whole thing went bonkers when they connected it to Etsy. Mm-hmm. And Etsy gave them, Etsy is an online, yes, you're shaking your head, an online market for crafters. So it's like an Amazon for the crafting people. But the strategic link was the internet access to the market. And that's true both for public housing residents in Rockford as it is for folks that live on a farm near Galena. It's access to market and being able to serve the market in, producing quality, on time, at value, at volume. And if you can do those four things, so that's the economic strategy. I remember working in Marianna, Arkansas, and we were there doing a quality of life plan on the day, literally on the day the last factory closed. And I'm thinking, what is the new strategy? Because for a place to first survive, then maybe even go on to thrive, so low-income people, you're absolutely right about who needs to benefit from this, right? But maybe they can go on to not be low-income people anymore. The only way to do that is to actually connect to market. And in my Southwest Side neighborhood of Chicago, the key play was building of the Orange Line that connects Midway to downtown, because all of the new jobs were in vertical properties downtown, in the financial service sector and other service sectors. But in rural Galena, it's connecting to market outside this area. And so the problem to solve for is very similar, but unlike doing LIHTC deals, every solution is going to be one-off and very different.
Right, and that's going to be the challenge going forward, is how do you write one CRA rule that accounts for all this? But I like those examples that we ended with. I mean, I think there's still, whether it's broadband financing or even financing transportation infrastructure, I think there's a way of figuring out a role for CRA to play in these kind of big questions. Well, good. Well, please join me in thanking our panel for all their thoughts.